Good afternoon and welcome to everybody that's joining us live today, and also those that are catching us on video or demand after the event. We've got a great conversation lined up for you today, addressing greenwashing in financial services. So my name is Tanya Etta. I'm the Executive Director for Education at the Chartered Bankers Institute, and I'm going to be your host for the next hour. I'm absolutely delighted to be joined today by three very esteemed panelists who are going to be looking at those challenging questions of greenwashing. Firstly, Dr. Nada Verk. Nada is a reader in finance at the Manchester Metropolitan University and specialises in asset finance and asset pricing, with a key interest in governance issues pertaining to environment, social and governance, as well as Islamic finance models. He has published his research in those areas in internationally leading finance and economic journals. So welcome. We also have Polly Sang with us today. Polly leads the Environment, Social and Governance in Financial Services Working Party at the Institute of Chartered Accountants in England and Wales. And she responds to those pivotal consultations under the Green Finance Strategy, such as the FCA's consultation in sustainable disclosure requirements, as well as investment labels. She authors a number of articles as well for the Institute and its members on sustainability. Welcome, Polly. And finally, Jonathan Haybrock. Jonathan's a senior analyst at the Green Finance Institute, where he works across portfolio of coalitions and projects, as well as supporting the Institute across its various operations on all of its work. He's got experience in the financial research section across various asset classes, financial products and sectors, having interned at Alliance Global Investment, Peel Hunt and Standard Life. So really big welcome and good afternoon to all of you. So let's get into this. Greenwashing. I think it's fair to say that people across the world are greatly concerned about climate change. We've seen enough of that. And there seems to be generally a willingness to make sacrifices to address those issues. But actually, there's probably less confidence in the efforts that are going on to solve the problem. It's probably also right to recognise, therefore, at this point, that in that space of solving the problem, there's quite a lot of friction involved, with many different organisations and partnerships needed to support the solutions that require such a sustained attention on many fronts. So it's not easy. This is not an easy space to be. And right at the heart of that is the finance sector, which we know is not well known for its sustainability credentials. Much progress being made. And if we think about what we're seeing at the moment, a recent investigation that I saw from Share Action Group found that only 1 in 5 of Europe's 20 largest banks published information on green finance target calculations. In addition to which, there's a lot of misinformation, fake news even, about climate change, with consumers and society therefore becoming really sceptical about the green campaigns and sustainable financial products that are becoming available on the market, and are starting to see this as what we're calling greenwashing. And just to be clear for us, greenwashing, for everybody listening, refers to the disinformation disseminated by an organisation, you can tell I'm reading this bit, to present a sustainably responsible public image for the benefit of that organisation. So we're seeing these challenges about actually what's happening in terms of the solutions, but also, is there a lot of claims going on with not a lot to back it up? So let's seek some views across our panelists. Are we really fair to challenge the financial sector, I guess, to start with this in this way? It feels like banks and other organisations broadly across the financial services sector are really making attempts to demonstrate their adaptation and adherence to incoming regulation, governance. Are they doing enough? Nader, what do you think? Let's start with you.
Thank you very much, Tanya, for having me on the panel. And it's an amazing discussion, considering the role ESG and sustainability is expected to play in our communities and in the next generation of innovation as well as growth, if I have to imagine that. And in that respect, greenwashing, considering that we are imagining a reconfiguration of economic and business processes, greenwashing is at the very heart of this drive. Considering just not that, we are not just talking about the reputational side for financial services and the banks therein. It's also kind of getting to the extent where financial services company might be seeking competitive advantage, by just matter of labeling their products by misstating or overstating, ESG environmental credentials. And if that is the case, the global financial crisis that we had in 2007 and 8, it was again, a governance issue in more ways, and it undermined the reputation of the financial sector the most in that respect. So in that way, it's very appropriate and very prudent that we challenge financial service sector not to engage into activities where the confidence in the sector, is again going down, considering, but the financial services sector and the banks, they are the powerhouse through which the finances move across the economy for SMEs, for large companies, and considering the backlash already that we have tend to see because of the fossil fuel funding. And again, most of the greenwashing is coming from that side of actions. And it also requires, how we are defining greenwashing. Is it just labeling of the product, or is the pledges that we are making in terms when we are underwriting loans for different, stakeholders in the economy, from firms or SMEs, or even mortgage loan? Because the other day we were talking about, in another, scenario that how much of the reimagining of the economy is required. And if we are simply putting statements or that are, meeting the statements or the pledges that banks or financial services companies has kind of signed up, but the work is not meeting in intent and in its outcomes, we have again reputational and investor, confidence type of meltdown. So I think, considering the history and the role financial services sector plays in the economy for all firms and individuals alike, we need challenging from the very onset to the extent that it becomes a bigger problem.
Thank you. Some great points pulled out there, particularly around the historical sector performance and what we've seen clearly happen over the last 25 years or so. Jonathan, is that fair though?
Yeah, I think it's very topical. I was just reading a news article before this webinar about greenwashing. So it's constantly being in the news. You're seeing more regulators and authorities trying to crack down on it. But going back to the definitions point, so if it's very simply a case of misleading practices of presenting financial products or activities as more environmentally sustainable than they are, it takes different forms, and that's why the definition is so difficult. So usually it's exuberant, exaggerated use of language and marketing, use of superlatives. I think generally just communicating on sustainability in general has been quite bullish. And that's a little bit strange considering that banks are still relatively immature in their processes that they have in place. So I think that all needs to be overhauled. That takes time, and they've just jumped the gun a bit. They put the cart before the horse, all the other idioms we want to use. But in terms of going back to the actual question, I think it's really important to maintain scrutiny on financial institutions for a whole host of different reasons. So, for instance, there's the risk to the financial system more generally, so financial stability. So all the reasons set out in Mark Carney's famous tragedy of the Horizon speech, so physical risks, transition risks, liability risks being a crucial one. And maybe if I just touch on that last one. So climate litigation, you're seeing so much more climate litigation in the news at the moment, holding banks and corporates to account. You've seen legal action against ING over its financing of fossil fuels. Recently, you've seen similar claims, accusations against the likes of BNP Paribas, HSBC over the last few years, but also against investors. So SEC investigations into WGS and others. So I think even organizations that have historically been anti-regulation, I think they're starting to see the necessity for greater policing and scrutiny in the space, just so they don't fall foul of these greenwashing accusations, because once you've developed a reputation, it's very difficult to move away from that and difficult to shake it off. But the final point, and something that we've been focusing on a little bit at the Green Finance Institute, is that there are still loopholes that exist. And it's something that was pointed out in the Share Action report you mentioned, Tanya, around one of the points was around facilitated emissions. And so fossil fuel exclusion policies on many banks just apply to their direct lending. So they can still provide significant sort of hidden or alternative financial support to fossil fuel companies through underwriting and advisory services. And it's taken about 2 years for banks to agree how much exposure, how much weighting they should apply for those facilitated emission transactions. And that sounds a little bit to me and others like the fox guarding the hen house, and there's a bit of double standards at play. So, banks have substantial and overlooked climate impact from some of their activities that's not coming out in their disclosures and reporting. And, we need more transparency around this. So I think the challenge to the financial sector is not only fair, but necessary in terms of ensuring that transparency, the accountability, and making sure that genuine progress is made towards sustainable finance.
Some really great points there, Jonathan, and a really good follow-up from Nader's points at the beginning there. And I think, if we start to then think about why are we in this space, why have we got such the issue around greenwashing, it sort of leads us into that next point, doesn't it? Because if we recognise it's fair to challenge it, then it's recognised to say it's fair to recognise that we've actually got some greenwashing going on. So Polly, could I bring you in at this point? If we've got such a key focus on green and sustainable finance, then why do you think there's such an issue around greenwashing, particularly in the finance sector?
Thanks, Tanya. Great question. Let's give it a context. So a really recent report from RepRisk, which is an ESG data compiler, has basically stated that the number of instances of greenwashing by banks and financial services companies around the world has risen by 70% the last 12 months. That's a big percentage, but why? I guess the main question is why. So I can summarize it in 3 parts: lack of framework, lack of assurance and accountability, and lack of knowledge. Happy to delve into each bucket in turn. So first, lack of framework. Currently, there is no universal definition of, say, for example, what is sustainable. So if you have a sustainable fund in the UK currently, and the UK government is bringing SCR to combat that, but currently, basically anyone can call their fund sustainable. It is estimated after the introduction of SDR that only 1/3 of the funds that are currently sustainable will still fit that bucket. But that is a real problem, because if you don't have a standard, then how can you hold people to account? So there are allegations of greenwashing, but at the same time, if green is not defined, how do you expect people to meet that standard? So that's one thing. And also I would add to that, there's a lack of, every country is developing their own green framework. So you got your EU, I know that's not a country, you've got UK, you've got US. At some point, there needs to be some kind of interoperability and a convergence, because currently the demands on preparers of accounts is great. Delving into the second bucket, lack of assurance, accountability. It kind of goes hand in hand with the framework. Now, I strongly believe that, similar to financial reporting, you have your standards, but you need an independent third party to hold preparers to account. This is what you see with financial statement audit opinions. It should be the same with ESG and sustainability targets. I don't see why not, because your company is setting a target in line with the standard. Somebody needs to come in and say, okay, you're 70% along that. But because of the lack of framework, assurers find it very difficult to provide that, that audit assurance and to kind of hold the stakeholders accountable, essentially. So that's the second bucket. The third is a lack of knowledge. And I'll give you a really good example of that. I think last year, there was somewhere in the world that decided that, you know what, to meet transition to net zero, we are going to drain the peat bogs and reforest, because forests produce oxygen. The problem is peat bogs are a great source of carbon capture. And that's actually, it flies in the face of transition to net zero. But I think linked to that is just that lack of education. So I think these trifecta of issues is why we see greenwashing persisting in financial services at this point in time.
A really great overview, and I love you bringing that to life through the peat bogs and the lack of knowledge, because that's a critical one, isn't it, in terms of getting understanding and base knowledge at the right levels to support it. Jonathan, what are you seeing in terms of that issue of greenwashing still hanging around the financial sector? Do you agree with what Polly's just walked through?
Yeah, definitely, and I'll be touching on some of those points, especially around interoperability. But everything, if we look a few years ago, everything looked great in terms of green lending. On the investment side, you've seen substantial flows into sustainable or green investment funds without much scrutiny. And quite often, let's be realistic, that was to attract clients, it was to attract assets under management fees associated. Yet the climate needle wasn't really changing. And so you needed to really understand why that was the case. And quite a lot of what happens in the market is because you see a repackaging, a sort of relabeling of funds and as green, sustainable, ESG, whatever you want to call it, rather than actually undergoing any sort of transformative changes to the business model or to the investment strategy. So there was quite clearly a disconnect, a market failure going on, in part due to, as Polly mentioned, the lack of a definition, reporting, data, standardization, those sorts of things. And I quite like a good sports analogy. And I think Tarek Fancy, who's the ex-CIO of Sustainable Investing at BlackRock, and I think he puts it really well when he likens it to a sports match, where competition works best when you have clear rules and you have referees and umpires in place to enforce those rules. And that's what we're missing. Thankfully, regulators are stepping in. You have sustainability reporting requirements, you have green taxonomies, transition plans, fund labeling, anti-greenwashing rules, which are coming into effect. But the market will ultimately have to adjust to those stricter, more meaningful definitions of green finance. And then hopefully over time, those regulations will converge and become less burdensome. So as Polly mentioned, different standards, capital is global. We've been working on the UK green taxonomy at the GFI and through the GTAG process. And we've got an internal tracker of 40 plus taxonomies around the world. That's 40 different frameworks, potentially at its worst, 40 different definitions of green for different economic activities. So there needs to be, it's great that we now have definitive definitions. The next step is to understand how those speak to each other. And you don't want some sort of regulatory arbitrage from one country to the next. That confuses investors. So yeah, it's great that we're introducing these measures. The next step is to make it not too burdensome to report against and make sure they speak to one another.
Some great points there. We've actually had some in the chat raised as well. And Nader, I was just wondering if I could bring you in here for your thoughts on this. We started to touch on it in terms of regulation there, but Michael Nichols has just raised the point. Is there not a fourth factor to Polly's 3, which is around enforcement?
Well, in that respect, Financial Conduct Authority has just, came up with, as Jonathan was also mentioning, the, anti-greenwashing rule. And that kind of if you're taking the case study, for enforcement in the UK context, and that is also applicable to the rest of the world as well in this case, that, with all the mislabeling or misinformation or lack of knowledge, as Polly was mentioning, whatever the divergences or disagreements are, I would also like to bring in that there is also multiplicity of ESG standards that also complicate all these 3 silos together with enforceability. And so with anti-greenwashing rule, there is a considerable drive that there will be more penalties coming the financial services sector way. And, that creates, that creates a new dimension to greenwashing, that it is creating a materiality from a reputational or a conduct risk to a litigation risk, because that is where banks, financial services companies are being challenged more and more. And to that extent, DWS, the subsidiary of Deutsche Bank, has been, fined $25 million, and this is just one example. And before that, so it is translating from those activists, processions or protests to really holding accountable to financial services sector and the companies who are really pushing the case for ESG products or ESG credentials, and through that there is in the backdrop the issue of greenwashing. And by one statistics, which is not great to really state that, but again, it really goes back to the amount of enforceability that 70% of the greenwashing cases, on the back of it, you can find banks. And, again, it's a troubling statistic. More of it is in the European demography. European banks are more often responsible for it, but American banks, they follow them over there. And again, the linkages again go back to something very, very standardized and something very material, and that is the impact on environment, the funding for fossil fuels, because that is where the change has to happen. Although there are quite a few activities, if I have to talk about in terms of good practices. I was just talking about SME funding, and how that will be reducing the greenhouse emission effect, let's say again within the UK, and it can reduce it by further 40%. That has been reduced by 70% in the last 20 years. So we are already on a path, but this greenwashing is taking a lot of shine away. But with the standardization, which is very complicated, I just want to highlight, we have GRI, Green Reporting Initiative, we have Task Force for Climate Change, and then we have ISSB, Sustainability Standards. Given what Polly mentioned, that how we finance sustainability or how we finance green, but the standardization has to reach a singular point of environmental impact of our practices and how that can create value with respect to innovation, social value as well, and keeping competition fair and square.
Some great points there, and equally I was really enjoying those examples that you're bringing to life where we've seen greenwash happening and also where we've seen some good practice. And I wonder, Jonathan, I was going to come back to you for a second. Could you give us an example of where you've seen greenwashing happening across the financial sector and possibly pull out something that's actually also positive, so where we've seen a positive action as well?
Well, yeah, happy to. I mean, when it comes to the greenwashing side, there's one often cited example, which is, I believe they're an engineering company called Wood Group, and they received a £430 million transition loan. And instead of advancing their renewables and sustainability carbon capture business, they actually expanded their oil and gas business by about 17%. And at the same time, their sustainability business unit saw a drop in revenue of, I think it was 35%. Over the same period. So that's not really commensurate with the goals and ambitions of transition finance. Yeah. Part of the issue here is around, as was previously mentioned, actually, the lack of repercussions and penalties. And so a lot of the greenwashing you're seeing at the moment is in the sustainability linked and transition finance space. So sustainability linked bonds, SLBs, quite often have weak sustainability performance targets, as well as minimal penalties for non-compliance. So we'd like to see an increase in the standards coupon penalty to a minimum of 50 basis points, and also an alignment with, or aligning those performance targets with science-based Paris-aligned trajectories. In terms of good practice, actually in the SLB space would be the likes of Enel, they're an energy company, and recently, I think it was last year, beginning of last year, they issued a 1.5 billion SLB aligned to the EU taxonomy. So we would encourage more alignment with the EU taxonomy, with the EU Green Bond Standard, which has been adopted as well, and obviously the UK taxonomy when it comes out. And then maybe another good example, just closer to home, I know our built environment team, I'll give them a bit of a shout out if that's all right, but they've developed some green home finance principles, so a bit of a framework developed with the LMA guidelines for the market on what sustainable finance going towards retrofit looks like. So having these guardrails in place and standards in place implemented by independent organizations, I think is really important to ensure best practice.
Oh, that's absolutely great. Thank you very much. Some really great examples there as well. I hope I was scribbling down, that's for sure, because there's some good ideas to take away and be able to support it. Polly, I just want to give you the opportunity. Is there any good practices that you wanted to bring in from your side of the sector at all that you've been seeing?
Yeah, definitely. So I think Jonathan makes a really good point. So transition finance, one of the issues is it's not really defined as to what is transition finance. And I think this is also a place where there's a lot of allegations of greenwashing and actual greenwashing in this space as a result. But one of the things that can help ensure that the sector, the financial sector, does actually genuinely apply transition finance is to follow the Transition Plan Task Force framework. They have a banking, asset management, and asset manager sector guidance specifically. So I think there's a lot of rules and regulations out there, and it may be quite difficult to make sense of it. But following the Transition Plan Task Force framework in coming up with a transition plan is a really, really, really good starting point. Because currently that is best practice, and ICAEW is on the steering and delivery group of TPT. I think it's really positive that this year being 2023, 2024, we've started to see some really kind of in-depth transition plans from the banks for the first time. So HSBC recently published it, NatWest published it as well, end of last quarter, I think. So I think that's definitely a step in the right direction. However, I do think it's very important for banks to continue to explain the assumptions used behind the data they're reporting and using the narrative to explain that it's a journey and also explain where the shortcomings are, because nobody's expecting it to be perfect, right? A lot of the time they have to use proxy data because the data is not there, and you have to make assumptions of the future because this is all forward-looking. But I think it will be really helpful to the readers of the financial statements, and also for people who want to invest in things, to actually see, okay, this is the reason we've settled on this date. We will accomplish this by this date. This is the data we're using. These are the areas we're not so sure about, but just explaining that and bringing stakeholders on the journey would be very, very helpful.
Brilliant. Thank you very much for sharing some of those great examples and ways to do it, which actually neatly leads us into the next part that I just wanted to explore a little bit, which is, you know, we've given the sector quite a hard time in the last 20 minutes or so in terms of the things that they need to be doing better. So what can be done more broadly? We've mentioned clearly some of those frameworks. We've mentioned some of those new areas that are being released to support the organisations and the sector more broadly. But Nada, perhaps I can come to you first. What do you see is really, really critical now that can be done to support the sector to really transition finance genuinely so that it contributes to those broader goals?
Oh, well, thanks, Tanya. Well, for me, you know, to make this, you know, make this change, the journey towards ESG and sustainability, you know, a realistic one. The biggest obstacle is, you know, the lack of capital movement. So there is one of the biggest problem is that with the increasing level of governmental debt, you know, fiscal space has become rather very limited, to the extent that the other day I was reading that in UK, Labour had a kind of plan that they will be spending £28 billion every year, but like they are backtracking on it. So you could see, you know, so the biggest obstacle, you know, towards achieving these, you know, or to make this journey a good one, realistic one, you know, the capital has to move. And in that space, you know, again, nothing comes better than the financial services sector, whether that is banking, whether that is asset managers, or even to the extent the third-party organizations that kind of quantify the working, reporting of financial institutions. So in that respect, you know, considering that obstacle, we have to really move, you know, better definition of transition finance and developing of products that really meets the pledges in a more reasonable and maybe in less bombastic way, if I have to say it, because that is what, the greenwashing problem has become, that, we are overstating, we are embellishing, we are trying to say things that are not there. Just in case, if we have to talk about responsible banking and the principles that has been stated, they have to count for the United Nations Sustainable Development Goals, as well as the Paris Agreement, the targets for greenhouse gases, as well as CO2. And, it offers, all the stakeholders so much that if they tick one box, they can have a very substantive kind of rating. And that has led, just today I was reading about that European Council has agreed to, to legislate on the role of ESG raters. So the standardization, with the multiplicity of standards and taxonomies and frameworks, we have to reach that convergence point. And once we achieve it, it has to move with the availability of capital. So we have to move from a more bombastic world to less bombastic world, where we have more action, considering the need for change. We can have standards, we can debate on standards, but to make the change happen, we have to wheel it with capital. And that is where the biggest opportunity is, to make the transition work. And again, just to talk about another statistic, because being empiricist in this field, the amount of funding required with the current level of, that is around $20 trillion US. By 2050, it has to go to 100 to 150 trillion US. And again, we are still talking in billions of it. So you could see the gap and the opportunity for economies and regulators. And more importantly for me, the powerhouse the banking and the financial services sector is in moving capital.
Fantastic points, Nader. Thank you so much. And Polly, I'm going to come back to you, because you raised those points around, why we still got issues and what we need in terms of the key three areas. But what else do you think needs to be done based on what you've just heard Nader talk through in terms of supporting the sector really come up with some genuine contributions, as we've just heard?
In terms of supporting the financial sector, so I mean, building on the 3 points that I mentioned, education across the board is definitely a thing that needs to be done. But I think also, taking a step back, people shouldn't view climate disaster risk or just climate risk in silo. Climate disaster risk is systemic financial risk. And I'll give you an example of what I mean by that. So last year, we saw a record number of storms, droughts. I mean, July was the hottest month on record. I think today the news was last year, global warming exceeded 1.5 degrees across an entire year, okay? The Paris Protocol is aiming for an average of 1.5 degrees on average, not in a year. So we're getting there. It is quite extreme, but that really has financial repercussions. If you think about it, the storms in California now has meant that a number of insurers are no longer insuring houses in California. This leads to stranded assets, People can't get a mortgage. They can't sell their house. What do you do with the house? This in turn impacts on your banks, because the mortgage books is like, oh, suddenly I have this asset, I can't sell it. What do I do with it? This has run-on problems with liquidity. Now the banks can't lend to further financial services and everyone else, and funding the actual transition. So I think, first of all, people need to recognize that climate risk is financial stability risk. And then secondly, the role of financial institutions in here as macro stewards, because you can see in the news, the Labour Party is ditching its policy of spending 28 billion on its green investment plan. The Conservative Party is pushing back their conservative goals until September. you need somebody to fund this change, no? And financial institutions have that role. Now, the issue is, it's not set out as to, I guess, what there's competing priorities. So you've got your transition to net zero. Now, bearing in mind, financial institutions operate across the world, right? Different countries have different targets for transition to net zero. UK has a target. India has a target. They are not coterminous. So that's something to bear in mind. So that's actually quite difficult to achieve already. And then the second point is, it's not just transition to net zero. That's the one that gets most coverage. But do not forget, there's also nature. There's biodiversity. And sometimes they are competing demands. I'll give you an example, electric vehicles, okay? In this transition to net zero, everybody's moving towards electric vehicles because, less emissions, all that. But the catch to that is there's parts of Chile that are completely being raided because we need lithium for batteries. And also there's the issue of, if you crash your electric vehicle, that's it. It's a write-off. You can't, unlike a normal kind of a petrol, you can fix it. With a battery, it's done. It's until they come up with a solution, it's going to go into landfill. So for a bank whose role is to kind of divest away from fossil fuels and invest in kind of cleaner technologies, it's not as simple as that. Because if you think about it, in the example I just gave, you've got, okay, you're investing in batteries, great, less emissions, but then your biodiversity and your nature parameters kind of go down as a result, because current practices are not sustainable. So, I mean, I do think we need to give financial institutions a bit of slack. They have a lot to do, but they are also, there's a lot of competing demands that they're dealing with. I think
very, very true. Lots and lots of competing demands. And I'm going to bring Nader in here. So he's got his hand up. So I think he's got a very hot point to raise.
Well, sorry, I have been forgetting so many things. So, as Polly was kind of bringing things, it gave me so in terms of one good example is, irrespective of the scale, I was just reading another statistic. Barclays, achieved their sustainability related funding targets 2 years before. So their sustainability related funding is 1 trillion £1 trillion already, and they have achieved that 2 years before. But having said that, the scale is not there, to the amount the change is required. And that talks about, again, to the financial stability as well as the resiliency of financial services sector, because if they are funding, projects that might not be material in the future, and they will be creating so much of climate change risk on the balance sheets of just not the companies, but also, indirectly on the banks, because they are funding it. So it will create, future crisis, contagion, and so on. Together with, it goes back to the materiality of climate change risk, just not financially, economically, socially, they are different for societies in global south and global north, and how prudently, again, with the capital flow and, solving a realistic, sustainable future or present today, it requires, a balancing act. It might not require, an activist kind of stance. We want the funds to flow, considering the issues that we have generated as humanity as a whole. They can be tracked back to 400 years or more, exponentially in last 200 years. So when we start talking about innovation and the balancing act, we have to see it in a blended or more, I would say, holistic way. It cannot be too drastic. It cannot be too radical. Innovation is not there because it's just not backtracking from pledges to finance it. Just last year, our Prime Minister also backtracked on phasing out of automobile vehicles, because we do not have the infrastructure, we do not have the innovation. So it has to be in a balanced way. It has to uplift the scales while considering the financial stability and the corporate resiliency, but it has to phased in more realistic way. Again, I want to really see banking sector and financial services sector, lobbying for good for once, maybe. And that could do a trick or two, just not funding it, lobbying with the regulators and the governments to really fund the change from innovation to reimagining of the infrastructures, which are the biggest emitter in terms of buildings and let's say farming as well. Sorry.
Oh, so no,
I went out of turn, but yeah.
No, you're not. There's no turn. It's the conversation that counts. So thank you for that. And I'm sitting here, Jonathan, thinking, gosh, we've got so much that we're expecting the finance sector to do in this area, and there genuinely is a lot to be done in this area. Is it a realistic expectation? And I guess, I suppose if it is realistic, over how long probably is another question to consider in terms of what banks and other organizations can do to sort of meet these expectations.
Sure, yeah. And I think it's important that we are ambitious when we're telling banks to align with environmental goals. I think the crucial thing when it comes to credit institutions and investors, quantitative data, numbers, it is their favorite toy. So the more you can give them, the better in terms of making investment decisions. And I think that's where the taxonomy, where corporate sustainability reporting comes in, because it provides the metrics and the data required for that effective decision-making that I mentioned. But even more important than that is almost the sequencing of how that comes about. So first you need corporate reporting to come before financial reporting so that they have that information at their disposal and change their practices. But even before that comes into effect, I think there are all sorts of things that banks could do as a intermediate step almost. So many of them specify already their green finance targets, but they're not sector specific, and they don't necessarily outline how they meet the overall targets that the firm has set. So that's one thing they should think about. Also, they don't clearly state, some have exclusion policies for fossil fuels, as has been touched on, but they're not terribly thorough. And again, there are loopholes there. And finally, again, a point that's briefly been mentioned around lobbying. One thing we'd also like to see is that banks work with policymakers and regulators rather than against them. So less of the heavy lobbying to exclude financial institutions from the Corporate Sustainability Due Diligence Directive, CSDDD recently, which would have ensured that financial institutions carry out environmental and human rights due diligence of companies in their supply chain. And so I really think that was a missed opportunity. But yeah, progress is being made, but there are steps certainly that they could be doing that wouldn't be too heavy a lift.
And if I can ask, I'm going to ask you a follow-up question actually we've had from the audience today, Patrick Wong, talking about green hushing. So this is sort of the extreme then we have a challenge with when we start to see some of these organizations where actually they sort of go the other way and actually start to underplay because they're concerned about what society will think about the things they're saying. So the opposite of greenwashing. How does that impact what we're expecting organizations to then deliver on?
Yeah, so I mean, I don't have an exact definition for you, but it's exactly that. It's not stating your environmental credentials, your sustainability credentials. And it almost feeds back to some of my opening remarks in terms of climate litigation. They're terrified by the prospects of being sued or being sort of held accountable, even at the board level. You have seen that with recent climate action against board members. I think it was Client Earth against Shell recently, taking their board to court. So I think you're better off. I think there is a cooling period that you see with the introduction of the EU Green Bond Standard and other standards coming through taxonomy reporting. There is a cooling effect for corporates, for financial institutions to prepare themselves and understand what this means for their business and their investment decisions. And so, yeah, you would expect them to take a few months to get used to what does this mean for us? What do these definitions, how do we transition our business accordingly? And so I think, yeah, the next phase is we've hopefully, for the green finance element, transition finance, very different, but hopefully reached and gone beyond peak greenwash, and that's in the rear view. At the moment, now we're entering the phase of green hushing, as an intermediate step to people then reporting their credentials. So it's sort of this phasing of approaches, but clearly an understanding that there is litigation risk that these organizations face.
Thank you very much for that. So I am going to just open up more broadly now to questions from the audience that are listening, if we can, and if we've got time to return to any of our other discussion points, we will do. But Polly, I wonder if I could come back to you. So Helen Davies, thank you for your question. I've heard some supposedly green venture capitalists are investing in Bitcoin, as well as green startups. This is obviously completely wrong due to the amount of energy required for a single Bitcoin transaction. Do you think this is because of a lack of framework or accountability or knowledge from the VCs, or all of the above?
It's a great question. So I saw this one and I was scratching my head a bit. I was like, how have they managed to sell Bitcoin as a sustainable investment? And I'm actually really curious to hear more about that one, because I have not seen it and I really want to know what the marketing is behind it. However, I guess this going back to your question, I think it's all of the above. It is the lack of regulation around it. I mean, if we're talking about crypto, we know it is very nascent. It's like sustainability, right? We've just had a discussion paper from the Bank of England and from FCA on stable coins. It is very nascent. So there's a lack of regulation. It's been like the wild, wild west at this point in time. So I'm not surprised that they're using Bitcoin to sell everything, okay? But sustainability is new. But also, I guess the lack of education, because as you rightly pointed out, the amount of energy you need to use to mine some of these, not everything, right? I think Ethereum is slightly less environmentally damaging, but I find it very curious that people, now without knowing what the ins and outs of what they're selling, but for people to see this and go like, oh yeah, I love to make a sustainable investment in Bitcoin. I find that that's just a lack of education in general, not just the public as well. And I think that kind of goes hand in hand back to the bogs example that I gave in the beginning. Yeah. It's really difficult. It's not just for the banks, financial institutions. As a public as well, it's very, very difficult to kind of reconcile the competing demands. For example, I think there's another question about ESG ratings. That is an absolute minefield. And I think a number of the ratings providers that were in the ESG ratings game have now decided not to give numerical indices because it is a quagmire. For example, I've seen some major airlines receive top marks in ESG. And that's because people forget it's environment, social, governance, right? They have excellent governance. So they've received top marks, but let's not forget an airline. They're major emitters. Like, how do you reconcile that? And I'm not saying it's an easy task, but yeah, definitely. There's a lot of education to be done. I feel like Jonathan has much to add.
There is. Jonathan's clear. He's got his hand up. So Jonathan.
Sure, thank you. What I would say, and I do think it is bizarre in some respects, and you read the reports about Bitcoin using more electricity than Argentina and some other countries. When it comes to blockchain technology, I do think there is a use case when it comes to sustainability. So we, for instance, do some work with an organization, the Global Battery Alliance, and was previously mentioned about material provenance mining in Chile, but also human rights violations in the Congo, biodiversity loss in Indonesia. And so they're looking at sustainable battery value chains and supply chains, and blockchain technology does allow for that traceability quite often. And so if you do have a physical twin, a digital ID of the actual battery asset, you have a digital representation, and you can trace via a blockchain, a digital ledger, where those materials come from and the transactions that happen in between. I think there are use cases for AI and blockchain there, but completely agree with Polly around green stablecoin and others.
Thank you, and I hope that's answered your question, Helen, online. We've got another question that I wanted to just bring out while we've got time to do so, from JP Peters from Convict Consulting, which you've mentioned, Polly, already a little bit. Is there a risk that ESG labels linked to regulation are confused with ESG ratings. Regulators are tasked with protecting against systemic risks, whereas investors seem to be relying on regulatory labeling to guide their investment decisions. Nader, can I come across to you for your views on this?
Thanks, Tanya. Definitely, this is, I think, a very important question. And again, I think that the traces to answer this question, has to go back, as the ESG term, gained momentum, and everybody wants to kind of have more sustainability into their portfolios, and they wanted to market it, and they wanted to enhance this, the overall assets under management into their portfolios. But like with this drive of it, the issue has really come back to, we are having so many of the raters, and considering airlines are getting the best ratings. And for example, just for the sake of example, banks, they are also having very good ESG ratings, and considering they are still, funding trillions of dollars into fossil fuel work. So we have to see the overall growth spectrum of economies, a local economy in the micro sense and the global economy in the macro sense, and how we can balance, the targets that we are setting for each other. And in that, kind of transitioning, there is a lot of uncertainty. I won't say confusion, because the standards have been in talk and discussion almost for now more than 20 years. So almost of more than 2 decades knowledge, literature, policy work has, have been in motion. But, somehow there is this, material or selfish behavior that really creeps in, and that creates that opportunity for portfolio managers or for rating agencies. And in that respect, I think the work from anti-greenwashing to labeling of ESG products has really gained momentum. And that is what I was referring to at the very beginning, that, European Council has really started, legislating on it, so that the raters' work will also be, how they will be held accountable for it. And in that respect, this rating agencies, they will be more simplified, they will be more standardized, and that is the opportunity. And that will kind of create that level playing field for portfolio managers in the financial services sector to really operate onto the credentials, not on the labels and the ratings that they are kind of getting from left, right, and center.
Thank you very much. And I think that is all the questions that we've had come through the Q&A. I just have one that I wanted to just finish on, because we've mentioned it in passing across all the conversations today, and that's about knowledge building and capacity building in terms of helping financial professionals really develop their knowledge around this whole subject. And I wonder if there's any guidance or advice that you would be giving to the sector in terms of how they go about doing this. Jonathan, could I come to you briefly around this one?
Sure, yes, and I would credit the Chartered Banker Institute and others as well for the great resources and courses that they have out there. I think it's really important that when it comes to green finance education and knowledge capacity building, it's really important that it's really embedded in financial institutions in the sense of not having at arm's length ESG teams and portfolio construction teams, compliance teams, but that the portfolio managers themselves have that skill set, that knowledge base that they can leverage. And so that it's quite often talked about, but rather than just having ESG investing, it's part of your fundamental analysis. And so those investment decisions are being based on ESG criteria, and they're factored in at every level throughout a bank or an investor, an asset management firm. So I think I would encourage people to continue to sign up for, I've done a couple myself, but continue to sign up for these types of courses to upskill themselves. There's been a lot of backlash around ESG and sustainable investing, but it's still firmly the way that finance is going. It's going to be called something else, but it's going to be mainstreamed. And so you need that skill set to be continue to be a relevant player amongst your competitors. And so, yeah, strongly urge people to sign up for these things.
Brilliant, thank you. What a great place to finish. Continuing professional development, I think, is the call of the day. Definitely, these things are changing so quickly. We need to make sure that we keep those updated. So I am going to bring it to a close there, because we are just coming up to the hour. Believe it or not, we've been debating and discussing now for a good 50 minutes. So firstly, I do want to say a very big thank you to Polly, Nader, and Jonathan for joining today and proving to be great panelists. Very engaging, interesting conversation. And as well, I'd like to take a big thank you to the teams at Manchester Metropolitan University, and also the Institute of Chartered Accountants, England and Wales, and of course the Chartered Banks Institute, for partnering today in the production and availability of the webcast. So thank you everybody for doing that. We mentioned resources quite a bit as we went through. You'll see there's been some that's been popped in the chat, but there's also some in the resources button on the Zoom call. As you can see now, they've been uploading. Equally, in a few days' time, this particular webcast will be available across YouTube and obviously across the institutes involved websites, where we'll also pop in there some links and details of where you can get that additional support, whether it's around the frameworks, the principles, or whether it's upskilling yourself in terms of capacity and capability. So that will be available in a few days' time. So with 3 minutes to spare, which will give everybody time just to go and grab a cup of tea, probably before the next call, I want to say a big, big thank you for everybody joining us live again and who's going to follow up. And we look forward to providing and partnershiping again to provide you with some more updates. Thank you very much, everybody.